In my dividend growth portfolio, I reinvest dividends once each month in the middle of the month. A few days ago, just before I was going to buy more shares of Schwab's U.S. Dividend Equity ETF, ticker symbol SCHD, the Fed made an announcement in the middle of the day. It announced that it was leaving interest rates unchanged for now and that it would accelerate its tapering of support for the economy. The market was still open when they made that announcement on Wednesday, December 15th, and the market reacted instantly to the news. Stock prices shot up and SCHD sailed right into overvalued territory. I want to tell you how I handled that situation. I'm Dave Van Napp for the Dividends and Income channel. Before I get going, please help us out by clicking the thumb up button if you like this content, subscribing to our channel, and ringing the bell so that you get notifications about when we post new videos, and also if you get a reply to a comment that you make underneath the video. Thanks a lot. What do you do when the price of a stock that you want becomes overvalued? Here's my advice. Stick to your investing plan. By that, I don't mean go ahead and buy the stock. I mean literally stick to your plan, your investing plan or your business plan. You should have your investing rules and tactics written out, and your investing plan should tell you what to do in that kind of situation. Maybe your plan says to go ahead and buy the stock, or buy it if it's only 5% or 10% overvalued. For me, that's not what my plan says. I place an emphasis on never overpaying for shares. So in this situation with SCHD going overvalued because of the Fed's announcement on Wednesday, so I switched my choice to Merck, ticker symbol MRK, the pharmaceutical giant. It's still undervalued even though the market went up after the Fed's announcement. Buying more shares of Merck allows me to expand an existing, small, high-quality position that I already have in my portfolio. Here's what Merck looked like before I made this reinvestment. What this display shows is at the top, the total that the portfolio holds, and then underneath 4 lines showing when I bought it. You can see that I started the position in May, bought more in June, and again in August. The total position right now circled in the top line is I hold 28 shares, and it's comprises 1.2% of my portfolio. Merck is a very high quality company. Here is its quality snapshot. Here's one of my famous quality snapshots for Merck. I've used them before. You've seen them if you've seen my videos before. I use 5 data sources for various quality aspects of a company, and I have devised a point system for each one. So reading quickly across, the value line safety grade for Merck is a 1 on their system, and that's the highest grade they give. In the second column, the value line financial strength grade for Merck is A++, and again, that's the highest grade they give. The third column, the Standard & Poor's credit rating is A+, and that is in the second of grades that S&P gives for credit. The fourth column, the Morningstar Moat rating, Morningstar awards Merck a wide moat, and again, that is the highest rating they give. And finally, Simply Safe Dividends rates the safety of dividend-paying companies, and it gives Merck 99 out of 100 points, which means that Merck's dividend is very safe and extremely unlikely to be cut. That grade was just reaffirmed after Merck's last earnings report in November. And off to the right, I use a 0 to 5 point system for each one of those 5 categories. Merck gets top grades in 4 of the 5 and the second highest grade in 1. So it ends up with 24 out of 25 points. I give that a letter grade of A, and it means Merck is a very high quality company. There are not many companies that end up with 24 or 25 points on this rather simple system. Here's a quick look at the company itself. It's in the healthcare sector. Merck is a mega cap company, very large. It has a current yield of 3.7%. A 5-year dividend growth rate of 6% per year, and it just announced a dividend increase of 6.2% that will take effect with its first payment in 2022. It has a 10-year streak of increasing its dividend every year, and it has paid 31 consecutive years of dividends, and in most of those years there was an increase. Its quality snapshot, which we saw just before, is 24 out of 25, an A grade, and its valuation is 18% undervalued. And now I want to speak to that for a moment. As you can see on this graph, Merck's price has been pretty stagnant for about 3 years. You can buy it today for approximately the same price that you could buy it in 2019, late 2018. However, its earnings have been growing. I highlighted across the bottom, those yellow highlights show Merck's annual growth in earnings per share. And in 2018, we see they grew their earnings by 9%, 20% the next year, 14% the year after that, just 2% this year, but projected to grow their earnings by 25% next year. My friends, is one of the setups, one of the scenarios that I like to buy stocks in, where you have growing earnings but a flat price. I don't know why the market does that, but sometimes it does, and when it does, it usually means that the stock is almost like a coiled spring. It has earnings, it's making money that hasn't been recognized by the stock market for some reason, and such stocks often present a good valuation. As I just mentioned, I ran my numbers on the 4 ways that I value stocks. They were all in agreement that Merck was undervalued, and when I averaged them all out, 18% undervalued. This slide shows my conclusions about Merck's valuation. I have a fair price range of $84 to $97 for Merck. I wouldn't pay more than $97 for it. And if you could get it at anything under $84, that's a discount. The bottom line of this same slide shows how that translates to yield, which is another way to think about valuation when you're looking at dividend-paying companies. So I would say at a fair price, Merck's yield is anywhere between 2.8 and 3.3%. When you get it at a discount, it's yielding something over 3.3%. And we already saw in an earlier display that Merck is currently yielding 3.7%. So it's well into its undervalued range as I made my purchase a couple of days ago. I got my shares at a little over $76 a share. That allowed me, with the money that I had from accumulated dividends since last month's reinvestment, that allowed me to buy 7 shares at a total cost of $534, and adding those 7 shares will add about $19 a year to my dividend growth rate of income coming into me. And I'll speak to the display. This display shows Merck's position in my portfolio now with the new shares added that I just bought. Near the bottom, I highlighted in yellow the transaction that I just showed you, the purchase on December 16th of 7 shares, costing a total of $534 and adding $19 a year to my income. And then at the top in the summary, you can see that the total position has now risen from 28 to 35 shares and now constitutes 1.5% of the portfolio. That's still a relatively small position, and as long as Merck remains undervalued, I will be adding more shares when I get the chance to do so. Here is the reinvestment's impact on my portfolio's annual rate of incoming dividends. My annual income run rate before the purchase was $5,394 a year, which is a yield on cost of 11.5%. After the purchase, adding in the $19, or after rounding $18 to that run rate, I'm now making $5,412 per year, which bumps the yield on cost up from 11.5% to 11.6%. That's a record high for this portfolio. And just to remind you what yield on cost means, the portfolio is now sending me cash dividends at the rate of 11.6% per year of the amount that I originally spent to start the portfolio back in 2008. I think that's pretty cool. It's why I started the portfolio back in 2008. I've never added new money to the portfolio, so all of that increased income coming in, 11.6% of the original amount I spent, has all been accomplished within the portfolio itself. I consider that to be organic. I've helped it along by the decisions I've made over the years, what stocks to buy, when to trim, and so on, but I've never put a dime of new money into the portfolio. This all results from the original investment that I made back in 2008. Here's the portfolio in a nutshell, and this is just an overview. At the end of the video, I'm going to scroll through the whole portfolio, and you can hit pause on your device and study it if you want to. But the overview is that this is an income-generating portfolio designed to generate a reliable and growing income stream. The portfolio was begun on June 1st, 2008, so it's now 13 and a half years old. Its starting value was around $46,700, and as I just told you, no new money has ever been added to it. Its current value is $173.1 thousand, which means that it's up 271% in those 13 and a half years. It has 35 positions in it. It has a dividend run rate, as we just saw after the reinvestment for this month, of $5,412 a year, which is an 11.6% yield on cost, and I reinvest those dividends every month. As I just told you, I don't add new capital to the portfolio ever, so I often say that leaves 3 remaining reasons why my income goes up steadily each year. Reason number 1 is dividend increases, meaning companies raise their dividends, most of them annually, and I choose companies that do that. In fact, 4 companies in the portfolio have already announced increases that will take effect in 2022, including Merck that I just bought. Reason number 2 is dividend reinvestments. I reinvest the dividends each month. And reason number 3 is occasional adjustments. Every so often, a stock becomes too big a part of the portfolio, or the investment thesis crashes, and I decide to either trim it or sell it and replace it with something else. There was an example of that in mid-2021 when I sold out of AT&T after they announced their reorganization plans. Focusing on reason number 2, reinvesting dividends, this table shows how those purchases create small, regular increments to the portfolio's dividend income. They seem insignificant each time, but they add up. The Merck purchase that I just made is highlighted in yellow near the bottom of the table, and highlighted in green with the year now complete, 12 reinvestments having been made. We can see the total impact. I've increased my income just through reinvestments by $210 a year, and that adds 4.3% to the annual run rate of dividends coming into the portfolio. Here's another way to think about that. If every stock in the portfolio froze its dividend, my income would still go up 4.3% simply from the dividend reinvestments that I made during the year. That is the very definition of compounding, making money on money already made. Here is how much each of the 3 mechanisms has added to my income run rate in 2021. Dividend increases have added about $271 to the annual run rate, or 5.6%. The reinvestments that I just talked about have added $210, or 4.3%. And I made several portfolio adjustments this year, and in the aggregate, they added $49 per year, or 1%. Finally, here is the total impact of those 3 mechanisms when you add them together for 2021 through mid-December, and I don't think this is going to change before the end of December. At the beginning of 2021, the annual dividend income run rate for my portfolio was $4,882, and after making this reinvestment and buying shares of Merck, it is now $5,412. That's a change of 10.5% in the annual run rate. That's not untypical for this portfolio. I've been averaging more than 10% a year increases over the last 9 or 10 years. So this one fits right in with the way the portfolio has been running. And with that, that's the update for this month. I'll say goodbye now, and we'll scroll the portfolio for you to check it out. Bye, everybody.